Cryptocurrency investing has exploded in popularity, attracting millions of new investors eager to cash in on digital assets like Bitcoin, Ethereum, and countless altcoins. While the crypto world offers exciting opportunities for profit and innovation, it also presents a steep learning curve and plenty of potential pitfalls for beginners. Unlike traditional markets, crypto investing comes with unique risks, rapid price swings, and a lack of regulatory protection. If you're just starting your journey into the world of crypto, knowing what mistakes to avoid can save you thousands of dollars, hours of frustration, and unnecessary setbacks. In this video, we'll uncover the top 10 beginner-friendly crypto investing mistakes you should watch out for and how to avoid them. 1. Investing without research. One of the most common mistakes beginners make is diving into crypto without thoroughly understanding what they're buying. Unlike stocks, where companies must disclose detailed financials, many cryptocurrencies operate in a far less regulated environment. Buying a coin simply because it's trending on social media or recommended by a friend can lead to disaster. It's essential to research the project's purpose, leadership team, use case, and roadmap. Learning the basics of blockchain technology and how each project works will equip you to make smarter investment decisions and avoid falling for scams or overhyped projects. 2. Putting all your money into one coin. Another classic error is going all in on a single cryptocurrency, hoping for massive returns. While big wins grab headlines, putting all your eggs in one basket can wipe out your portfolio if that coin crashes or fails. Diversification is crucial in the volatile world of crypto. Instead of betting on just one asset, spread your investments across multiple coins, including more established ones like Bitcoin and Ethereum, and a few carefully selected altcoins. This strategy reduces your overall risk and increases your chances of capturing gains from different sectors of the crypto market. 3. Ignoring security practices. Unlike traditional finance where banks offer protection, crypto requires you to be your own bank. Beginners often neglect basic security practices, leaving their assets vulnerable to hacks, phishing scams, and even losing access to their funds. Storing large amounts of crypto on exchanges is risky because exchanges can be hacked or go bankrupt. Instead, use hardware wallets or trusted software wallets, enable two-factor authentication, 2FA, and never share your private keys with anyone. Learning to protect your investments is just as important as choosing the right assets to buy. 4. Chasing pump and dump schemes. Many beginners get lured into pump and dump schemes where coins suddenly skyrocket in value based on artificial hype, only to crash dramatically after insiders sell. These scams are common in the crypto world, especially with small, low-volume coins. If a coin's price skyrockets overnight without any major news or technological breakthrough, it's often a sign of manipulation. Always be cautious of investments driven by hype alone. Focus on projects with real utility, strong communities, and long-term potential rather than chasing quick profits based on speculation. 5. Not having an exit strategy. Entering a crypto trade without knowing when to exit is like driving without a destination. You're more likely to crash. Many beginners either sell too early in fear or hold on too long expecting never-ending gains. Having a clear plan about your profit targets and acceptable losses will help you avoid emotional decision-making. Decide in advance what percentage gains you're satisfied with and how much loss you're willing to tolerate before taking action. Setting sell targets and stop-loss levels ensures that you manage risk intelligently instead of reacting impulsively to market swings. 6. Getting swayed by fear and greed. Crypto markets are highly emotional, often swinging wildly based on news, social media chatter, or celebrity endorsements. Beginners frequently get swept up in fear of missing out, FOMO, during price spikes or sell in panic during crashes. Successful investors recognize that emotions are their worst enemy. They stick to their investment strategy regardless of market sentiment. Learning to stay calm and rational, even when prices are moving rapidly, will give you a huge edge. If you feel emotional about a trade, it's often better to pause and reevaluate before making any moves. 7. Overtrading. In an effort to maximize gains, many beginners fall into the trap of constantly buying and selling based on short-term price movements. Overtrading not only racks up fees but also increases the chances of making poor decisions based on short-term noise rather than long-term trends. Every trade should have a clear reason behind it, supported by research and analysis. Patience often beats frantic trading in the world of crypto. Remember, sometimes the best move is simply to hold onto quality assets and let time do the heavy lifting. 8. Ignoring tax obligations. Many newcomers to crypto investing are unaware that cryptocurrency transactions often have tax implications. In the US, for example, the IRS treats crypto as property, meaning that every time you sell, trade, or even spend your crypto, it could trigger a taxable event. Ignoring tax obligations can result in hefty penalties later. It's essential to track all your transactions, know the basics of crypto taxation, and consult a tax professional if necessary. Using crypto tax software can also make the process easier. Treat your crypto investing like a real financial activity with real responsibilities. 9. Following influencers blindly. Crypto Twitter, YouTube, and TikTok are full of influencers offering advice, but not all of them have your best interests at heart. Some are paid to promote projects without disclosing conflicts of interest, while others are simply guessing. Blindly following influencers can lead to devastating losses. Always double-check any investment recommendation you receive online. Do your own due diligence before putting any money into a project. While it's fine to gather ideas from others, your investment decisions should be based on your independent research, not internet hype. 10. Investing more than you can afford to lose. The most important rule in crypto investing is never to invest more than you can afford to lose. Cryptocurrencies are extremely volatile, and while the upside potential is high, the downside risk is just as real. Many beginners invest money they can't afford to lose, such as rent money or emergency savings, only to find themselves in financial ruin when markets dip. Approach crypto with a risk capital mindset. Only invest money that, if lost, wouldn't dramatically impact your life. This strategy will help you stay calm, sleep better at night, and make rational decisions even in volatile markets. Cryptocurrency investing offers tremendous opportunities, but it also demands education, discipline, and caution, especially for beginners. Many of the mistakes covered in this guide stem from a lack of knowledge, emotional decision-making, and poor preparation. By recognizing these traps early and taking proactive steps to avoid them, you'll dramatically increase your chances of success and longevity in the crypto space. Remember, investing wisely isn't about chasing the hottest coin or making a quick fortune. It's about building a sustainable strategy that grows your wealth over time. Take your time, stay curious, protect your assets, and treat your crypto journey as a marathon, not a sprint. The crypto world rewards those who are patient, disciplined, and always willing to learn.